Hello, everyone, and thank you for joining us for this educational webinar on alternative lending options for small business owners. My name is Austin Pantaleo. I am a volunteer for this TFI initiative, and I also work closely with today's speaker on sharing the best practices regarding borrowing in Canada. Today, we're going to be hearing from Kevin Clark. Kevin is a nationally recognized leader in the alternative lending industry. He also serves as the chairman of the Canadian Lenders Association and is the president of Lendified, a leading Canadian alternative lender and technology company. Prior to this, Kevin spent 30 years with the Bank of Nova Scotia, where his most recent role was focused on overseeing a number of global businesses, including the bank's international lending activities. He's a graduate of Western University and remains active within the Richard Ivey School of Business. We certainly hope you find this webinar useful and would like to welcome Kevin.
Thank you very much, Austin. It's great to be a part of this, and thanks to the TFI for hosting all the ongoing activities as it relates to small business financing, particularly in Ontario. I'll start with just a little bit of background. I had spent 30 years with the Bank of Nova Scotia in a variety of capacities, and most of it in the lending space. And I certainly came to realize the opportunities that might be being missed in the small business lending space, and took it upon myself, upon following out of the bank, to join and co-found a business by the name of Lendified, which is, as Austin said, an active player in the small business lending space here in Canada. I also happen to chair the Canadian Lenders Association, which is an association we founded several years ago to try to ensure that there's a voice being heard by the new entrants of lending activity that's going on in Canada. And that relates to both the consumer space as well as the commercial space being the focus of our discussion today. The webinar is really designed to try to bring some awareness to a number of things. What we're going to focus on today is just challenge with the Canadian business lending landscape as we see it, and how alternative lenders have emerged to help fill the void that's taking place. And I'd like to spend a bit of time with you all just on picking the right lender and solution for the needs of small businesses in the capital markets today. So the goal is really to help you understand your options and make the right decision as it relates to your business. So let's talk about the challenge with Canada's business lending landscape today. I guess we all know that there have been challenges in the larger lending institutions in Canada bringing focus to the lending space for small businesses. And it's not that there is any desire not to serve the community. In fact, I would argue that the larger institutions do a fantastic job in building operating relationships and putting product in front of small businesses. The challenge has really been about how easy and how accessible is the products and services that are coming through from larger organizations into the lending space and small business. And the friction and the pain points of getting access to capital is kind of well known in the space today. And I'm the first to observe as a former banker that a lot of time and money is being spent on how we can all be better at serving the needs of small businesses in Canada and Ontario. And what we've seen, and I will get into this around what the alternative lenders are doing, but the challenge has been, how do we actually bring focus to this marketplace? And really what's been happening in this space has been a combination of a number of challenges that have sort of flowed up to the point where a new space has opened up for alternatives to play a role in. One of the reasons that that's happened is the fact that naturally as lenders, the economies of scale suggest that for the amount of time being spent on providing credit to small business, that same amount of time can be spent on larger credits, and that tends to drive a lot of account management focused on the small business into the upper ends of those curves, so that we see funds flowing into the hands of larger companies rather than smaller companies, simply because of efficiencies. And the fact that it's really hard to scale small business risk means that the amount of time spent on small business exposures is just the same as the amount of time being spent on larger exposures. And so that's where one falls in the interest of earning as much as one can from the time spent. And lastly, it's one of these things that's sort of hard to articulate, but there is an issue with public exposure on what the real price point is for the risk, and are larger institutions and public institutions comfortable with how they manage that exposure to the marketplace. And so one of the easier ways to prevent that is to really not lend into markets where you've got higher required margins to really equalize the risk versus return. So we've naturally just seen this sort of deficiency become created in small business lending and the SME space generally. And so what that's really meant is that there's opportunities. I think it's really hard to quantify the amount of capital that's actually been missing from this space. Like there has been reports of billions of dollars that go unmet in terms of the demand and requests made by small businesses to their local lender in whatever form. And I can't deny, as the head of a burgeoning alternative lender, that we see declines too happen through our process. But the reality is that it's put a tremendous amount of pressure on our economy, not seeing the billions of dollars that have been requested be met in the interest of allowing such an important part of our economy grow and develop. And once again, I set the stage for the value proposition of alternative lenders coming in to potentially fill a void. At the end of the day, it's a real challenge for small businesses to get access to capital. And so what happens is that they naturally fall into owners putting in funds into the company, leveraging their personal credit position. That happens. I think the number is probably 55 to 60% of small business owners are funding their companies in one form or another through their own personal credit scores. And that puts downward pressure on their own personal finance situation in the interest of trying to provide capital into the small business marketplace. Borrowing from friends and family tends to be a way that many businesses, as they get started, find the funds to grow, and it's become quite a challenge. And so I set the stage again for the opportunities at hand. So what started to take place, and I guess one could think about the financial crisis as a good place to sort of start, that post-2008, 2009, the emergence of technology and the consideration for new ways to do business has trickled into the financial marketplace. And I think slowly, with a lot of financial services now being available online, has given the Canadian marketplace a way of starting to consider whether or not they can trust and be comfortable with accessing financial services online, as opposed to traditional ways of meeting with professionals for the need for financial services. And I think it's really been probably the last 3 years where we really see the burgeoning of financial services online coming into the Canadian marketplace. And as we can all guess, as relatively conservative people, we follow that of the same statistics that are going on in the US that's much further along in the acceptability of financial services online. And in fact, they follow Europe in the broader global move towards financial services being accepted and found through online services. And so here we are in Canada in a position where conservatively we're now branching out to see that access to such needs as capital can in fact be trusted and provided through the use of online financial services. So the emergence of Canadian lenders, it was sort of interesting, and there was an article actually in the paper today about fintech leaving too many Canadians behind. It was in the Globe and Mail as an opinion column, and it just speaks to the need for borrowers to be well aware of what their true needs are when they search for capital in the marketplace. But in some cases, it really feels like there's a propensity now for seeing a lot of activity coming into the marketplace. And there's a lot of growing awareness and education and willingness and trust now emerging in the marketplace. So let's think about what actually is happening in the space. Well, alternative lenders are a group of companies that have been providing for some period of time now access to capital and product into the marketplace that has traditionally been done through what we would call the Schedule A Chartered Bank Act, or through the credit unions that have been long established in Canada. And while there has been always sort of a fragmented industry of providers of private capital, the emergence of technology has given us a way of accessing the consumer and the small business marketplace, a legitimate way of, through online access and portals, the applicability of accessing capital through application processes online, and avoiding the needs of physical delivery and physical presentation for the purposes of obtaining credit. In fact, really what's quite interesting now is we're seeing applicants come through looking for credit, not just between the business hours of 9 and 5, but between the hours of 5 and 9. So it's really quite interesting to see how these companies are now delivering financial products online. But probably one of the biggest differences is the fact that these players, and I make the statement that they're not regulated, and that's not to scare people to think that if you're not regulated, you're not well governed and trustworthy. It's simply to make the point that the regulated industries are focused where the assets are moving from the customer into the financial institution. So many of these providers, in fact, almost most of the alternative lenders, aren't actual deposit takers. So they don't carry what they would view as assets in the form of deposits or liabilities from them to the borrower. And so the focus is really on the provision of capital through the lending business, and the funding comes otherwise instead of through the deposit taking activities. And so it's not regulated in the same fashion that the banks are. So the focus for these lenders tends to be around what product they've developed and how they seek to serve the market. And that's an important part of our discussion today. So when we think about how many players have actually considered using financial services online to support their business, there's a variety of sources out there. And one of the ones that we thought would be interesting to you would be to see the source of Smarter Money Loans survey, which talked about a 50% hit rate in terms of number of customers, small business borrowers actually using online services to find capital in the last few years. I think the number is particularly high, but it is certainly possible. And we know one thing's for certain, that it's certainly going in one direction. The general acceptance is increasing and getting better and better. So what I'd like to do is just flip into a couple of pros and cons on what's happening in the marketplace. So not to scare you away, but there's just to show you what's going on in this place, is that there's a large number of customers. This little chart that we've provided here on alternative financing landscape, which relates to North America, is appropriately heavy skewed into the US market, but it gives you a sense of the significance and the proliferation of product and services that are coming into the financial landscape. Fundamentally, though, all with the objective of appealing to a value proposition that through the use of financial technology, there are ways of providing better services and upgraded services to the consumer. The pros being higher approval rates. Well, there's certainly an interest in trying to grow a business, so there's an interest in higher approvals. There's also the fact that given the technology that's being used, that the credit analysis can be enhanced, and therefore better approvals can be expected. The technology is providing for new product and new services as the demand grows, so there's more loan options available. And generally it's easier in the interest of what needs to be provided to win the approval process. Traditional approvals demand business forecasts and pro formas and views to the future on the capacity of the business. Most fintech organizations look historically backward and look at the recent flows of the business in the interest of trying to make decisions on near future expectations for the business. As a consequence, the products tend not to be delivered for as long a period of time. So we don't see fintechs or alternatives generally providing 5 and 7 year money. That's sort of still in the bank market, but we do see shorter term product being provided. And rates can be quite varied depending on the assessment of the risk and the demand for the capital. So we do see generally priced alternative lending activity as being higher than what we would see in the traditional banking markets. And not all the lenders are equal. Not all of them have been established. Not all of them have been established on the grounds of financial services experience or credit adjudication pedigree and so forth. So it's not to say that one needs to be careful. It's simply that one wants to make sure they're dealing with the counterparty that they expect to be dealing with. So what I think might be good to do would be to just look at what are the differences in terms of products that are being offered and so forth. I think I'll just put the slide up here and then we'll just go through it. But what's interesting is that there's kind of 4 categories that the alternative lenders have focused on. And installment loans may be the most popular one. Certainly working capital provision is a broad-reaching product that can assist small businesses for many uses of capital. That can include the purchase of assets, just being aware of the fact that one should always be matching their liabilities with their assets. And so if you're looking for a truck, then you probably want a lending product that's going to last the duration of the truck. If you're looking for inventory, then you've got shorter term borrowing options. The concept of matching liabilities and assets is an important one. So the installment loan tends to be a good place for small businesses to go online for credit and to look for product that has declining balance processes, so it brings some discipline to the repayment process. The speed of which these products are approved is typically quick. The effort and the application process for most borrowers is relatively efficient, so we consider it to be of minimal effort to do. And the cost can vary, but generally we like to think of it as credit card rates, but there are certainly ways of having that a little lower and having it a little higher depending on the application that's coming through and the actual risk counterparty exposure. Merchant cash advances tend to be focused on companies that have payment processor revenues. They tend to be for high street retail and wherever credit cards can be taken. That tends to be the higher demand for merchant cash advance product, and the access to capital through that process is measured through the sales receipts across the processor. So lenders in that space can see right at hand what flows are moving through the company's tills. And that's a good thing for the lender. It's certainly also good for the proprietor in knowing what the flows are and the access to capital. The challenge for the lender is that it doesn't give them as much scrutiny on what's happening at the bottom end of the income statement. In other words, what the profits actually look like. So they tend to be much more expensive so that they can offset expected higher losses. So while it's relatively quick and efficient, it also typically comes with a relatively high cost. They're also more often quite short in terms. And so one needs to be cognizant of the fact that one will pay higher amounts for the credit and it won't last as long. But to the point, it certainly has its application. Invoice factoring and invoicing against receivables has been around for a long time. To see it in the sort of technology advanced position with online application processes and not having massive paper trails is again a technologically advanced process, and there's a few factoring businesses out there within the fintech space that have created some space and certainly provide for a good use of their product. The challenge here is that the small business really needs to be providing product for higher quality credit, because it's that credit that's going to be used to drive certain of the decisioning around the pricing. So small companies producing product for big companies is a good place. Small companies producing product for small companies doesn't necessarily earn the same kind of benefit in terms of the cost of the capital. So we see it as a sort of a medium to a high, depending on the counterparty risk. Nevertheless, it's certainly a product that has value if a company is generating significant receivables and has a history and can show typical repayment to an existing established user of the product. Then they can probably benefit from such a product. And then lastly, I thought I'd just mention lines of credit, because lines of credit are everybody's wish list in the business world. Lines of credit provide access to capital when needed. Repayment can be made when wanted. And it exists as probably the most preferred credit product out there. The challenge, of course, is that more assessment of the credit needs to take place. Much more difficult for smaller businesses to get access to the credit. Therefore, more work is going to be done in order to warrant the approvals from those that provide lines of credit. And the cost is typically lower on the basis that the counterparty risk is typically lower. And that flows in from low sort of to medium. We don't tend to see high expensive lines of credit, but that is moving into the alternative world to some extent. And so gives you a sense of what's going on in the space. So these four products tend to dominate the lending space. I think what's interesting for all of you as small business borrowers is that many of these products are tried on to fit the same need. And I think what's important is to try to understand, given the cash flow situation or given the needs of the company, what truly is the best product that can be used to satisfy that need on an ongoing basis. Clearly, the installment loan is something different from a factoring. The merchant cash advance has different costs in the line of credit. I mean, these are things that the small business borrower needs to consider. The challenge, of course, being where actually can they access that capital and how easily can they qualify for any of the products. So picking the right solution and the right lender is kind of a hard thing to really recommend. As the chair of the Canadian Lenders Association, we have a number of members. We have a growing member base, and all of them are anxious to get their brand put forward and to be a part of the lending landscape in Canada. All I can tell you is that there are a number of things that one should really be thinking about. First and foremost, who the lender is. I think there's a pedigree that becomes associated with any brand, and I think while it's easy to perhaps put in place a pretty slick website for people to look at, I think it's important that you can see the bios of a management team and understand as well the disclosure on rates and costs to be sure that you've got the best lender for what you believe your needs are. The application process and time to funding are points that are relevant to one of the reasons that alternative lenders tend to provide higher fees and higher rates is because there is the benefit to having that. One can wait months in the traditional way of application with the corner branch. You just never know. There is the benefit, I think, to getting a no within a day as opposed to getting a no in 3 weeks or 6 weeks. So time to funding and the application process are 2 points that are relevant to the alternative lending space. And I can assure you that most lenders in this space, certainly including our firm at Lendified, is quite focused on the customer experience and the attempt to draw information as best one can to create solutions and answers with the minimum amount of time and effort by the customer. The type of loan I sort of explained, the term length is they're not long-term products, these products generally. If you think about the the time you might have a receivable outstanding, that's the time you would have an invoice discounting product outstanding. Term loans tend to amortize over relatively short periods of time because if you have higher amounts of credit, then you need typically longer periods to borrow and to repay. That becomes complicated for small business. So amortization schedules tend to play a role in the term length. And amortization can vary from daily repayment through to biweekly to monthly, and for terms, as I say, up to several years. And that's important to try to match that with the flows of your business. Many alternative lenders demand daily repayments. Certainly in the merchant cash advance space, daily repayment takes place because there's daily revenues. So it's important to find a lender that tends to align up with the flows of your business. Costs and rates are generally disclosed. In fact, the CLA seeks to ensure that its members have good disclosure and that everybody's aware of costs related to the business. There's not a lot of hidden fees that go on really in the space. I mean, the legitimacy of the alternative lender space is quite significant. And while unlike the traditional lenders, there may be higher costs involved in interest, the traditional fee structures are not that different from the way the fee structures are built with all the lenders in Canada. Prepayment penalties tend to be tied to interest costs that are sitting on the loan. So it is important to have a view on whether or not you expect to see your loan amortized to its full completion, because prepayment typically means the interest that hasn't been paid will be paid upon prepayment. And so it's important that you understand the language around that. And probably the most important thing on this page for many people is security and what needs to be provided. In the small business lending space, what we found through the alternative lenders is that there's very much a willingness to take subordinated positions behind other lenders, principally the larger established, the Canadian banks or the credit union space tends to be a very well respected space and so forth. And in fact, the credit opinions are always respected, and most alternative lenders are prepared to sit behind them. The challenge is such that looking at the cash flows mainly for repayment, there's usually the offset and the ask for personal guarantees. A personal guarantee from the owner is a legitimate ask, I believe, given the commitment that they have to their business. It's sort of the classic of having skin in the game. And this ranges for companies probably up to 20 employees. Once these companies are larger, personal guarantees fall away with general assignments just against the company. But these are all things to be considered as part of the borrowing decision. So I'm going to stop there. I know we have a couple of questions that have been sent in and were previously provided, but that does end the formal part of the webinar. So I hope that that's been of interest to you and valuable in how you critique and assess your needs for credit and where you go for credit. But the general online lending space is active. There is certainly a lot of activity going on in the larger organizations on how they can streamline systems and processes to provide equally competitive product into the small business space. For now, though, certainly the financial technology-driven lenders are gaining a market share and earning a reputation for quality product, and certainly have established themselves in the Canadian market as they have elsewhere. So I see I've got a question in, so I'm going to take these few questions here and just see where things go. The first one is around unconventional / new methods out there to assess a business in order to approve them for a loan. It's interesting that the credit processes that are leveraging technology, we often talk about social media and profiles, and can we contribute one's LinkedIn membership or so forth to a credit decision? The answer is possibly yes. The question is, what is the appropriate weighting for such disclosure? Someone who has a large LinkedIn profile or has other active social media content might be considered to be through a number of data points, a better borrower, but it certainly doesn't contribute a significant amount of the weighting to make a decision. Other things such as HomeStar's ratings and other ratings that are public and user experience ratings that come back against companies are valuable inputs, but again, aren't necessarily going to be driving decision-making activity. What we have found is the traditional ways of analyzing financial statements has somewhat been displaced by the use of bank statement data and understanding what the activities are going through the operating accounts as perhaps a preferred way of getting a short-term, up-to-date awareness of what the cash flows look like in a particular company. So I would say the answer is that there are new ways of looking at traditional analysis and some ways of looking at new analysis to make the credit decision. And we'll see where it goes. The use of data is extremely powerful now, and social content and so forth is slowly going to creep into the decision and add some component to it, but will not drive it. So there's another question that just popped up that I'll just capture. Is Lendify currently accepting applications, and what kind of applicants are you prioritizing? For most alternative lenders, there's not a priority per se as flows move through application into adjudication within the alternative lending space. There may be some industries that tend to have restriction in terms of capacity as portfolio balancing as these companies all seek to grow their loan books. But I would say that one thing to be aware of is that most of the alternative lenders do have a minimum time in business that they like to focus on, and for most it's a year in business. Larger firms, established firms, even the Business Development Corporation of Canada, the BDC, provides a significant amount of credit into the small business space, demands 2 years of operating activity before they'll consider loans. So with the alternative space generally being a year, maybe plus or minus a little bit, but the key being that most alternative lenders want to know that there's a value proposition that's been established by the business, that it's up and operating and has revenues. So they tend not to be providing funds to startups, if you will. Startups typically, and I've done other webinars in the space around what's needed between debt and equity. And certainly for startups, there's a need for equity to be in these businesses in order for that business to actually attract the interest of debt capacity, because one likes to know that there's been committed capital into the business by the owners. The applicants that come through generally don't get prioritized. It's all about meeting our stated objectives of a quick turnaround. So we see a lot of lenders trying to manage the time from when the application is received through the adjudication process through to funding. And it's generally pretty slick in most organizations, but it does depend on the particular skill sets and the way the technology has been spent, sometimes on the front end, sometimes on the core credit engine, sometimes on the funding. So generally it's relatively quick, and generally it beats the ability to turn from the traditional organizations, and that's part of the value proposition and why capital is a little bit more expensive. Another one that's popped up is, I just referred to this one that came in earlier. What rate should I expect when I deal with an alternative lender? Again, it's particularly difficult to assess what the rate should be. I can only tell you that in general, there's an understanding that one needs to get paid for the risk they're taking. And as I tried to articulate earlier, the value proposition for most alternative lenders is such that getting the money out quicker should be worthy of some cost higher than what we would normally see in the traditional bank markets. I think something to remember is that for most alternative lenders, the cost of capital for them also is higher. It's not like they've been established for a long time, and so their costs of capital are slowly coming down. But as I said earlier, as not having deposits means they're not funding themselves from a relatively low capital base. So all of us can appreciate the earnings that we earn with our accounts. It's not a big number. And that's the cost of capital that the bank is, or the credit union or other traditional deposit takers are using as their cost of capital. Whereas for most of the alternative lenders, they are borrowing in the wholesale market, so it's a little more expensive. But the good news is that most of them are putting out fixed rates. So you're getting a rate that's good for the term of your credit and not going to fluctuate as market rates fluctuate in the marketplace. Another one that's come in, thank you for the presentation. What do you advise businesses seeking alternative financing in the 7 to 8 figures, tens of millions? Well, that's clearly an interesting comment. The reality is for larger firms is that one should start to deviate from having one core lender to probably several. And while I indicated that alternative lenders are prepared to sit behind other lenders, what typically lenders look for as commercial lenders through the banking markets is to be the lender, and they will displace other lenders in the interest of capturing all of the credit product to provide for that company so that they can take out all the other operating fees and alternative services can be directed to them on the basis that they're providing the capital. And it becomes a difficult space for the borrower to actually try to generate multiple relationships. But for those that are borrowing 7 or 8 figures, certainly diversified borrower or diversified lending is important for the borrower, and a variety of terms is important. Typically, large companies that are borrowing in the millions of dollars, and there's probably a few on this call that are in that space, those have long-term assets. So mortgaging property, mortgaging land, putting in place long-term product, long-term capital is a good thing to do to manage the general fixed cost of the company. And at the same time, seeking what I pointed out earlier, lines of credit are particularly valuable because they can meet short-term and long-term obligations for periods of time. Another question that's come in are solutions that I could recommend for consulting services, but have limited collateral. Funds are needed for resource expansion. Invoice factoring is not desired. So this is a great question because we get so many customers in this space that don't have the assets that traditionally will be demanded by larger lenders for security purposes. And this is truly where alternative lenders do actually create a true value proposition that really holds. And that is that in the consulting space, as an example, the overhead cost is really payroll and rent because the services is cerebral. Consulting is all about leveraging skill sets. And so there aren't a lot of fixed assets to support the loan. So what's taking place here is a need for cash flow lending, and the alternative lenders particularly focus, certainly us at Lendify, focus on cash flow as our core financial determinant. And to be a little bit specific, what we're going to do is analyze the ins and outs of the operating accounts for the last number of months, typically 6 to 12, and determine what operating cash flow looks like, drive to generally a profitability statement and understanding, subtract from that the financial obligations that are going out of the firm, and then look at the carrying capacity for any future credit. This is particularly appropriate for consulting firms. It's also a big issue for logistics companies. There are other companies in this space that really apply to this, and so cash flow lending is particularly important. So thanks for the question. Can a small business acquire a larger loan when partnering with a $500 million international corporation in shared services? Well, the answer is yes. The question becomes, what is the partnership really trying to provide, and does that partnership provide guarantees in any fashion to the obligations of the borrower? I think the reality is people get the sense that their business is bigger than it really is often. And general contractors fall into this space a lot, where they're taking in significant revenues, but they have significant obligations outside of their core business at the same time. And so really their business is a lot smaller than they think it is. And so my caution on this point, acquiring a larger loan and partnering with a larger firm is all interesting, but at the end of the day, if the cash flows are having to support the obligations from the smaller entity, then that's the borrowing capacity of the smaller entity. Unless there's a guarantee attached to the partnership, it would be a dangerous play to think that by virtue of larger partnerships, that the size of the business is good. And lots of companies fall into this trap where their assets suggest, or their size suggests that they can borrow, but truly their cash flows tell you otherwise. So one needs to be particularly concerned about that. I've got a couple other questions that have come in. What should I do if I need funding to start a business? Well, I think the point on that is really not necessarily for the alternative lending space, although all of us would have an interest once the business is up and running. I think the point there comes back to the debt equity discussion about what is needed and when can one leverage one versus the other. And startups need equity. There's just no doubt about it. There has to be commitment coming from whoever the visionary is that has the business that they're about to build or want to build or believe that they can build, and that has to come first. And I admittedly understand it can be a tough start, but that's the challenge of small business, and it almost doesn't change with growth. Existing businesses that have acceptable balance sheets and cash flow, when growth opportunities arrive, there is often a need for capital, and the equity just isn't there, but because it's already in the business. And there may not be enough retained earnings coming through on a quarterly or annual business basis to increase that equity. And I respect there that leverage becomes probably the only alternative. And I think good lenders understand that, and cash flow lenders can be prepared to deal with that and have more debt than equity that's in the business. It's all about the ability of the company to carry it. So I get it. And I have one more question that's come in, and that will add to our questions here. What alternative lender should I go to? Well, it's not my position to speak to the names of businesses that are out there. There's a lot. There are businesses that are built and homegrown from here in Canada, and there are businesses that have come into Canada from foreign markets. Typically, the United States has been a marketplace where, if I think of Lendified here in Canada, there's probably 10 Lendifieds in the United States, and some of them are looking at the Canadian market. And I don't know whether small business owners like to wave flags or whether they're solely focused on whatever's best. But I don't think personally adjudicating credit from a distance is a good way to do business. So I've always had the view that if I'm going to borrow money, I'm going to borrow it locally. That's not waving flags. That's just the what I grew up in, and understanding how credit should be underwritten and where one's borrower should be. But my view would be that there are some good lenders in Canada, and to come back to the product profiling, it's important to see what one thinks the needs are and try to put in place the appropriate credit to manage cost and access to capital to grow your business. For Lendified, just to answer a general question on knowledge in the industry and how we're trying to help small business, I think for us uniquely as founders from the banking space, we have a little bit of a Boy Scout approach to wanting to help small business in Canada, and I'm certainly open to some discussion generally about providing support and guidance on a consulting basis, sort of as part of the business. I would like to think that there are a number of providers out there that help support small businesses in Canada. Interestingly enough, I think there are financial service plays coming through payroll, coming through HR, coming through the payment space, coming through the insurance space. Yes, of course, having spoken about the credit space. There are a lot of very innovative activities going on to help small businesses. And frankly, if I may say, being a small business myself, small business has never had it so good in Canada thanks to the use of technology. I think the important thing is how does one leverage it to manage cost and to get access to the services that are necessary at the right cost and the right amount of time and expense to manage it to help grow your independent business. But I personally would always welcome the opportunity to speak with a small business owner without being inundated, but just to have chats about what's going on in the industry. I find it fascinating. So thanks for the comment.
Thank you very much, Kevin. That brings us to the end of today's discussion. If you'd like some more details on alternative lending solutions, we encourage you to visit the two websites here, where you can get detailed guides on the different options that are available, and also some best practices on how to really understand the options that you have in picking the right solution. Oh, it looks like we have one more question that came in.
Got a couple more. I guess we can, well, just a thank you. So that's nice to hear. So thank you all very much for taking the time. I hope it was valuable to you. You can always reach me through LinkedIn, and I thank you for the time, and I wish you all the best in your business.
Thank you so much, everyone.